Hello, welcome to this week's Financial Friday. Every Friday, I do a live video talking about one aspect of buying or selling a home, and this week it is Credit Score 101. How your score impacts your mortgage rates and how to improve it. So the first part here is how your score impacts your mortgage rates. And most banks have kind of not a hard rule, but somewhere around a limit of they like to see about 680 or higher for your credit score. Now, that is most banks. We do classify the majority of banks as A lenders, which would be like your top best rate lenders. Now, when you have a lower credit score than 680, not always, but often, you would have to go to something called a B lender. And that B lender typically has a higher interest rate. So when your score is not as great, we're actually looking at a higher interest rate because there's a higher risk involved in lending to you. So they then are able to profit a little bit more because there's a higher risk, and so they want a higher reward. Now, when we're looking at improving your credit score, I absolutely love talking about this because there is not enough information out there. And I like to make sure that people are informed and know exactly how to do this. So the first thing that you look at when it comes to your credit score is your debt utilization ratio, okay? So for easy numbers, let's say you have a credit card with $1,000 on it. If you owe $900 or $1,000, the banks actually look at it as higher of a risk because you are using more of the credit available to you to live off of. So that would be, in the $1,000 instance, that would be a 90% utilization of your credit. When you bring your credit score or your credit utilization down to under 30%, so in this scenario, 300, you're actually going to increase your score because you're showing that you know how to use credit responsibly. And that shows positive light on you that you can use credit to a small extent. Even if you brought it up to $1,000 and paid it down under that 30%, that still looks really good on you because you're using your credit responsibly. You can show that you know how to handle money. Now, they're also going to look at your payment history. And so that payment history, you want to make sure you have no late payments and, more importantly, no missed payments, because those missed payments can drop your score considerably. Something like I've seen 80, 90 points dropped. So it can take you years to recover from that. And that's a really, really huge factor. So make sure you do not miss any payments. At bare minimum, always make the minimum payment on time. Have it set on automatic payments even, because that will make your life so much easier. Now, furthermore, they're going to be looking at the different types of credit that you have. So a mortgage is just one type of credit. A credit card is another, a line of credit, loans, those are all different kinds of types of credit. And this comes down to, again, showing that you can use your credit responsibly, showing that you know how to manage it, that you're making all these different types of payments on your own. And so that's a big way that they're looking at to see, can we trust somebody with a mortgage? Are they able to make these payments? So no matter what you're doing, the banks are constantly looking to see how responsible you can be with that credit and how you can then improve it. So other questions that I get are like, my credit's at 550. How can I quickly bring it up? And so the advice that I give is make sure you have every payment, that you make sure every payment is on time, at least the minimum payment, and bring that credit utilization down to under 30%. And that would be on something like a credit card. A loan, of course, is very different because they're loaning you a total amount and then you're slowly paying it back in predetermined intervals. But for a credit card, that's kind of a free use thing. So if you can bring that down under 30%, that would be my top tip for you. And I've seen that make such a huge impact in people's lives. Also, just the amount overall of debt that you have. So if you've got a car loan and a credit card and a line of credit and everything, and if you owe a little bit on everything, that can really impact, like your overall payment amounts, right? So if you can focus on one thing and really work on paying that down, that can make a really big difference for you too. So that is my top tips for this week's Financial Friday. Join me next week on Friday for some more Financial Friday tips. All right, have a great weekend. Bye.